Silver alert. Vanishing in real time. This has never happened before. The world's largest bullion dealers, SD Bullion, Bullion, APMEX, completely sold out of 1,000-ounce silver bars. The big bars, the ones that back the paper contracts, gone. Shipping delays stretching to 25 business days. Google searches for buy silver hitting all-time highs, even surpassing 2011. Two top analysts are now calling for $100 silver. Not years from now, but within weeks. And over the weekend, a major geopolitical event just changed everything. What's really happening in the silver market right now? And more importantly, what does this mean for your wealth in the coming months? Stay with me, because what I'm about to reveal will change the way you look at precious metals forever. And welcome back, old friend, to Currency Archive. If you've been down here with us before, you know we don't just scratch the surface. We dig deeper. We uncover what others miss. And if this is your first time finding us, well, you've just stumbled into something special. Do me a favor, will you? Hit that subscribe button. Not for me, but for yourself. Because the information we share here, it's the kind that could protect your future. And while you're at it, ring that notification bell. Trust me, you won't want to miss what's coming next. Your time is valuable, and we honor that. So let's get into it. The precious metals market was experiencing something unprecedented, something that had never been witnessed before in modern history. And it was happening right now, in real time. Across the United States, reports were flooding in. The major bullion dealers, the giants of the industry, were facing a crisis. SD Bullion, Bullion, and APMEX. These weren't small players. These were the titans, and they had just run out of something critical. The 1,000-ounce COMEX good delivery silver bars, gone, completely sold out. These weren't the small retail coins that everyday people bought. These were the big bars, the institutional bars, the ones used on major exchanges, the ones that supposedly backed up all those paper contracts, and they had vanished. What made this even more alarming was what it represented. This wasn't about retail investors buying a few coins. This was about the big players, the serious money, moving in. Physical demand wasn't just increasing, it was overtaking the paper supply, and that changed everything. Market observers rushed to their local coin shops to see what was happening on the ground. What they found was equally disturbing. At one major coin shop, a large establishment with over 40 employees, the clerks were telling customers something they rarely had to say. They weren't completely wiped out, not yet, but their inventory was under serious stress. Silver was moving faster than they could restock it. One experienced clerk, someone who had worked there for over 20 years. He had seen many markets, many cycles, but even he admitted that this was different. The pressure on inventory was becoming intense. Online, the situation was even more revealing. Researchers began checking the major bullion dealer websites. 10-ounce bars, 1-ounce bars, popular coins. Many items showed the same status, not available or pre-order only. But there was something else, something that couldn't be hidden. Every major online dealer was now posting warnings. Shipping delays, not the usual 2 to 3 days, but 10 days, 15 days, even longer. TD Precious Metals had just announced something shocking. Delivery delays of up to 25 business days. That was 5 weeks. 5 weeks to get silver that normally shipped in days. Their notice was clear. Due to high demand, they suggested customers visit retail locations instead, but even that came with a disclaimer. Subject to availability. The market was scrambling. That was the only word that fit. Not quite a shortage, not yet a squeeze, but definitely a scramble. Physical silver was becoming harder and harder to acquire, and the world was starting to notice. Technology revealed another fascinating piece of evidence. Google Trends data showed something extraordinary. Searches for buy silver had reached an all-time high. The chart was stunning. It showed data going back to 2011, back to the last major silver surge. That peak in 2011, when silver hit $50, that had been the previous record for search interest. There was also a spike during the pandemic, during the chaos of 2020. But now, in early 2026, the search volume had exploded past both of those peaks. People were waking up. The masses, the ones who had ignored precious metals for years, they were suddenly paying attention. Something was shifting in the collective consciousness. And it was happening fast. Meanwhile, halfway around the world, another scene was unfolding. China, the massive Shenzhen Shuibei gold market. During their 4-day holiday at the start of January, the crowds had returned. Footage from the scene showed something remarkable. People packed into the market, moving between vendors, looking, buying, securing their positions in precious metals. The Chinese New Year was approaching in mid-February, and Chinese citizens knew what that meant. They were preparing, protecting their wealth. moving their money into something tangible, something real. The activity level was intense, not quite panic, but certainly urgency. Back in the West, analysts were trying to make sense of it all. One thing was becoming crystal clear. The traditional rules were changing. For decades, the retail market had never set the price of silver. Retail demand had only affected premiums, the extra cost above the spot price. The real price, that had always been determined by the paper market, by the futures contracts, by COMEX, by the big institutions. But now, something fundamental was shifting. Physical demand was beginning to challenge the paper price. And if that continued, everything everyone thought they knew about precious metals was about to be rewritten. The question wasn't whether change was coming. The question was, how fast and how dramatic would it be? While the retail scramble intensified, something far more significant was happening beneath the surface, something that most people weren't paying attention to. But the smart money, they saw it clearly. The central banks, the puppet masters of global finance, they were making a move, a historic move. For decades, these institutions had played by one rule: hold U.S. treasuries, hold dollars. That was the game. Since 1980, the world's central banks had consistently held more American debt than gold. It was the foundation of the global financial system. The dollar as king, treasuries as the safe haven. But a chart released by Bloomberg revealed something shocking. That 40-year trend had just reversed. The crossover had happened. For the first time since the early 1980s, central banks now held more gold than U.S. treasuries. The yellow line on the chart told the story. From 1980 to 1995, gold holdings had climbed steadily. Then, from 1995 to around 2020, treasuries had dominated. The world had bet everything on the dollar. But starting in 2018, something changed. The gold line began rising sharply, while the treasury line started falling. Not gradually, but deliberately. These weren't random fluctuations. These were calculated decisions by the smartest financial minds on the planet. The people who controlled trillions of dollars, they were moving away from paper and back to metal. And where gold went, silver always followed. Whispers began circulating in financial circles. Some central banks weren't just buying gold anymore. They were starting to look at silver. It hadn't been confirmed, not officially. But the rumors were there, persistent and growing. If that proved true, if central banks began accumulating silver the way they had accumulated gold, the market would explode. Because unlike gold, silver was already in a supply deficit. It was being consumed, used up in thousands of industrial applications. Solar panels, electronics, medical devices, AI data centers, electric vehicles needed silver, lots of it. Every modern technology depended on it. And unlike gold, once silver was used, it rarely got recycled. It was gone, forever. While the big players positioned themselves, the analysts started speaking up. Two prominent voices in the precious metals world, both highly respected, both with track records of accurate predictions. They were now saying the same thing, $100 per ounce. Not someday, not eventually, but soon, very soon. The first analyst, Rashad, had been eerily accurate lately. His predictions over the past year had come true again and again, and now he was looking at the silver chart, studying the patterns. His conclusion was bold. Silver was about to sprint higher, to test the $100 level, then pause, just like it had paused around $50 before continuing its climb. He pointed out something remarkable. Silver had tripled in 2025, within just 9 months, from $25 to $75. If it tripled again in 2026, the price would reach $200 or more. His chart showed the trajectory, the zones, the potential, and he believed it would happen sooner rather than later. The second analyst, Gary Wagner, was equally confident. He saw something forming on the charts, a bull flag consolidation pattern. The technical traders knew what that meant. It was like a flag on a pole, the pole representing the massive surge upward, and the flag representing a brief pause, a consolidation. But bull flags almost always broke upward. That was their nature. Gary's prediction was specific. Once the metals finished their minor profit-taking event, probably within the coming week, silver would be set up to test $100. And his timeline? 1 to 2 months. Not years, not even quarters. Months. Two major analysts, independent of each other, both calling for triple-digit silver in the near term. But there were skeptics. There always were. Some voices began calling it a bubble. The classic response whenever something moved too fast, too high. Silver can't sustain these prices. It's irrational exuberance. This will crash just like it did before. But one analyst, Jesse Colombo, saw through the noise. he published a response that silenced many of the critics. His argument was simple, yet devastating to the bubble theory. He said, "Those calling silver a bubble are misled by nominal gains." Nominal, or that word was key, because nominal just meant the number, the face value, the dollar amount. But nominal didn't account for reality. Jesse pointed to multiple metrics that told a different story. The silver to Dow ratio, still far below historical averages. The silver to money supply ratio, nowhere near previous peaks when measured against the growth of global money printing. When compared to the explosion in the M2 money supply, silver wasn't expensive at all. In fact, it was still cheap, historically cheap. He showed a chart, the silver to Dow ratio indexed to 100. It went back to 1980, when silver had hit $50 for the first time. That peak in 1980, that was true mania. Then came 2011, another significant peak, but still lower than 1980. And now, 2026, with silver at $75, the ratio was still well below both previous peaks. Silver had room to run, a lot of room. The nominal price might seem high, but the real price, adjusted for inflation, for money supply, for economic reality, it was nowhere near its true potential. And then there was the gold to silver ratio, the number that told perhaps the most important story of all. Throughout human history, one ratio had remained remarkably stable, the relationship between gold and silver. It had guided civilizations, determined wealth, shaped economies, and right now that ratio was screaming something important. But most people weren't listening. The current gold to silver ratio sat at approximately 60 to 1. That meant it took 60 ounces of silver to equal the value of 1 ounce of gold. On the surface, that might seem normal. But when placed against the backdrop of history, it revealed something extraordinary. A researcher had compiled data going back thousands of years, and the chart he created, it was eye-opening. In ancient Egypt, around 100 BC, the ratio was 10 to 1, only 10 ounces of silver for 1 ounce of gold. If that ratio applied today, with gold at $4,400 per ounce, silver would be trading at $440, not $75, but $440. The journey through history continued. In Rome, during the height of the empire, the ratio was 12 to 1. In Italy, in the year 1300, 15 to 1. Germany in 1500, back to 10 to 1. Even as recently as the modern era, the ratios were far lower than today. Throughout most of recorded history, silver had held much greater value relative to gold. The current ratio of 60 to 1, it was an anomaly, a distortion, an aberration. But there was something even more important, something that made the current situation unprecedented. In ancient times, silver wasn't consumed. It was used for coins, for jewelry, and for decoration. But it wasn't destroyed in the process. That silver still existed. It could be melted down, reused, recycled. Today, everything had changed. Silver was being consumed, used up, destroyed. Solar panels required silver. When once installed, that silver was gone for decades. Electronics needed silver. And when those devices were thrown away, the tiny amounts of silver inside, economically impossible to recover. Medical applications, antimicrobial coatings, industrial processes, all consuming silver, permanently removing it from the available supply. Electric vehicles, each one contained significant amounts of silver. The push toward green energy, toward electrification, it was creating unprecedented demand. And then there was artificial intelligence. The data centers powering AI, they required massive amounts of silver. Every server, every connection, every component, silver made it possible. The technological revolution wasn't just using silver, it was devouring it. Yet the price ratio suggested silver was worth less, relative to gold, than at almost any point in human history. The disconnect was staggering. But there was another factor, one that few were discussing yet, one that would become, in the years ahead, a massive driver of demand. Tokenization. The digital revolution was coming to precious metals, and it was going to change everything. A company called Tether had already proven the concept with gold. They had created XAUT, a digital token, each one backed by 1 real ounce of gold, stored in actual vaults in Switzerland, fully audited, completely transparent. The benefits were revolutionary. People could own gold, real physical gold, but transfer it digitally. They could trade fractional amounts, no need to buy full ounces. They could move their wealth across borders, instantly, without physically carrying metal. They could buy and sell 24 hours a day, 7 days a week, no waiting for coin shops to open, no paying massive premiums. The spread between buy and sell prices, minimal compared to physical dealers. And the demand, it had been enormous. Tether had become, outside of central banks, one of the largest buyers of physical gold in the world. They were accumulating thousands of tons. Because every token they issued required real metal backing it. The same thing was coming for silver. It had to be. The infrastructure was already being built. The technology already existed. It was only a matter of time. And when tokenized silver launched, when it became easy to own, when people could buy $10 worth, or 100, or 1,000, without worrying about storage, without paying huge premiums, the demand would be astronomical. Some in the precious metals community resisted this idea. If you don't hold it, you don't own it, they said. And they weren't wrong, not entirely. Physical possession had its place, its importance, its security. But the market didn't care about ideology. The market cared about accessibility, convenience, and opportunity. Just as the SLV ETF had created massive demand for physical silver years ago, despite all its critics, despite all its controversies, tokenization would do the same, but bigger, much bigger. Because blockchain technology offered something ETFs never could. True transparency, real-time auditing, verifiable backing. The future was being built right now, and silver was positioned at the center of it. 5 years from now, people would look back and realize they had witnessed the beginning, the moment when digital and physical merged, when ancient money met modern technology, when silver transformed from industrial metal into a globally accessible, digitally transferable store of value. But while all these long-term factors were aligning, something immediate, something urgent, had just occurred. An event over the weekend. A geopolitical earthquake that would send shockwaves through the precious metals market. And it was about to change everything in ways most people couldn't yet comprehend. The Venezuela situation, it wasn't just another news story. It was a catalyst, a turning point, and the implications, they were just beginning to unfold. The weekend had brought news that shook the world. And though many didn't yet realize it, the precious metals market would never be the same. Venezuela, a bold move by the United States, a takeover, unprecedented in modern times. The details were still emerging, the full story still unfolding, but the implications, they were crystal clear, and they pointed in one direction. Higher prices for gold and silver. As markets prepared to open, tension filled the air. Traders were positioning, investors were watching. The opening bell would bring volatility. That much was certain. Some expected fireworks to the upside. Others feared a sharp correction downward. The short-term reaction, it could go either way. 50-50 odds, a coin flip in the darkness. If the market opened down, if silver pulled back, that would be okay, even expected. Because the long-term picture, that was what truly mattered. And the long-term picture, it had just become significantly more bullish. The Venezuela situation paralleled something from recent history, the Russia-Ukraine conflict. When that war began, when Russia moved into Ukraine, the West had responded with unprecedented financial sanctions. They seized Russian assets, froze central bank reserves, took control of billions, perhaps trillions of wealth. And the world watched. Other nations watched. And they learned. China watched and grew concerned. If Western powers could simply seize assets, if they could freeze reserves with the stroke of a pen, then no wealth held in Western systems was truly safe. That realization had triggered something profound. A shift away from dollar-based assets, a movement toward hard assets, toward gold, toward silver. And now, Venezuela had reinforced that lesson. The United States had taken control of an entire country, a major oil producer, a strategic asset, and other nations were taking note. China and Russia, already skeptical of Western financial systems, they were now even more motivated to divest from dollar dependence. The wedge between East and West was growing wider. The world was fracturing, dividing, and in that division, precious metals found their purpose. Some analysts were already speculating about next moves. Would China feel emboldened to move on Taiwan? Would Russia escalate in Ukraine? These were tinderbox situations, volatile and unpredictable. But regardless of how those scenarios played out, one thing was undeniable. The world was becoming more fragmented, more adversarial, more uncertain. And in times of uncertainty, in periods of geopolitical tension, in eras of declining trust between nations, gold and silver had always thrived. History proved this again and again and again. When empires clashed, precious metals rose. When currencies failed, gold and silver endured. When governments overreached, people sought protection in tangible wealth. This wasn't speculation, this was pattern recognition. And the pattern was repeating, right now, in real time. The East, particularly China, was already exerting enormous influence in precious metals markets. They were buying, accumulating, stockpiling. While Western investors chased stocks and crypto, Eastern powers were securing physical metal, and they weren't stopping. The coming years, the next 2, 5, 10 years, they would be defined by this dynamic. The continued tension between East and West, the ongoing weaponization of financial systems, the persistent drive toward de-dollarization, all of it, every single factor, pointed toward a supportive environment for precious metals. When all the fundamentals were considered together, when every piece of evidence was laid out, the conclusion became overwhelming. This wasn't just a good time to own silver and gold. This was potentially the best opportunity in a generation, perhaps in multiple generations. No other period in the last 25 years, not 2008, not 2011, not 2020, had offered such a compelling combination of factors. Supply shortages, check. Central bank accumulation, check. Industrial demand explosion, check. Geopolitical instability, check. Currency debasement, check. Technological revolution requiring silver, check. Coming tokenization, creating new demand, check. Analysts calling for triple-digit prices, check. The list went on and on, every fundamental indicator pointing the same direction. And yet, the silver-to-gold ratio suggested silver was undervalued. The silver-to-money supply ratio showed enormous upside potential. Historical precedent indicated current prices were, in real terms, still low. One researcher had calculated something fascinating. If silver were priced against the M2 money supply growth, adjusted for the actual expansion of global currency, the real price of silver should be over $1,000 per ounce. $1,000. That wasn't a prediction. That was just mathematical reality. The amount of currency created versus the amount of silver mined, the numbers didn't lie. Of course, silver didn't need to reach $1,000 to change lives. Even $100, even $200 would represent life-altering returns for those positioned correctly. And the analysts, the ones with proven track records, they were saying $100 could happen within months, not years, not decades, months. The next 30, 60, 90 days, they could be absolutely critical. The market was at an inflection point, a moment of decision, where the patient, the prepared, the informed would be separated from everyone else, those who understood what was happening, those who recognized the unprecedented nature of this moment. They were taking action, not panicking, not rushing blindly, but deliberately, strategically, positioning themselves, because they understood something fundamental, something that transcended charts and predictions. Paper money, throughout all of human history, had always, eventually, become worthless. Every fiat currency ever created had failed. The Roman denarius, the German paper mark, the Zimbabwe dollar, Confederate currency, Weimar marks, Argentine pesos. The list of failed paper was endless, and the current system, the dollar-based global reserve system, was showing cracks, serious cracks. That didn't mean collapse was imminent. That didn't mean the dollar would disappear tomorrow, but it meant the trajectory was clear. And in that trajectory, in that inevitable decline, gold and silver stood as the alternative. The insurance policy, the wealth preservation tool, the one form of money that had survived every empire, every collapse, every crisis. For 5,000 years, silver and gold had held value, and they would continue holding value long after current governments, current currencies, current systems had faded into history books. The opportunity was here. The evidence was overwhelming. The time was now. Those who recognized this moment, those who acted on this information, they would look back years from now and realize they had witnessed something special. The greatest precious metals bull market in modern history, perhaps in all of history. It was happening right now, in real time, and there would be no second chances. The silver was vanishing, the truth was emerging, and the future belonged to those who understood. This was the alert. This was the warning. This was the moment.